Linda from the Chamber. If you guys are just joining us, we're thrilled to have you. We're going to be kicking off in just a few more minutes. Hope you're having an enjoyable morning so far. We sure are having one here at the Chamber office where we're launching from. Okay, without further ado, if we are all ready to get started, I am Linda, your program manager at the Chamber, and I am very happy to introduce our speaker today. We always hear about how we have to exercise our bodies, but we all know we also have to exercise our financial muscles. Or do we know that? You're going to find that out today in our session. I'm going to turn it over to you, Sonja Haggert, and go for it.
Okay. Good morning. Before I start, I'd like to do a little bit of housekeeping. I don't want to be distracted by pulling down the chat box, so I'm not going to be checking it. If you have any questions, please put them in the chat box, and I will hope to get back to them at the end. If I don't get to your question or I can't answer it, I'll get back to you if you leave me your email in the chat box. I don't know where you are in your investment journey, and I wasn't able to find that out. So I kind of had to guess on my presentation. So I hope you find this helpful. A little bit about me. I'm not a financial advisor. I don't have any letters after my name. Throughout my career, from my studies at Villanova to my last job as the vice president of a manufacturing company, I was exposed to investment information. And I realized it wasn't that hard. In fact, it allowed my husband and I to retire in our 50s. So fast forward to today, and I'm doing what I love. I've written a book, I have a newsletter and a blog, and I found out it's not that hard to be either a DIY investor or with a financial advisor. I'm all about practical advice, which is what I want to share with you. So enough about me. Let's talk about you. Some reasons that women should become involved in their family's investments. The divorce rate for couples over 50 has doubled since the 1990s. You may become widowed all of a sudden. Women live on average 5 years longer than men. In a Gallup ShareCare study, almost 90% of people who managed their finances well had a strong relationship with their partner or spouse. But there's an even bigger reason. 9 out of 10 women will be responsible for their or their family's finances at some point in their lives. And that can become an expensive situation. Let me give you a personal example. My parents were living in an independent living facility, and we found out that my mother had stage 4 colon cancer. We had to move her into the nursing facility, which was $20,000 a month. My dad, who's not used to taking care of himself and took this very badly, was moved to assisted living at $10,000 a month. That's a lot of money, and I had to know where to get it. Now, those are huge motivations. But on a lighter note, here's mine. I'm very security conscious. I was always worried about, oh dear, God forbid I become a bag lady. But reality check, 54% of men will have their wives taking care of them when they're 85. Only 16% of women. So what are we going to talk about today? Well, what I'm hoping is to make you comfortable with the investment world, to help you navigate what's out there, and to provide you with some resources to evaluate your investments. Now, there may be some reasons you're hesitant to invest, and the volatility and coronavirus are certainly topics. And if you've been following the market this week, it's been pretty tough. You may be afraid of risk. You may feel like you have an unfamiliarity with a lot of topics, and you may not know what questions to ask or what stocks to pick. What to do? Well, first of all, make sure your financial house is in order. Do you have a detailed budget? I have a very detailed Excel spreadsheet budget. And again, if any of you would like me to share it with you, I'd be happy to if you put your email in the chat. I also have a resource page at the end with apps. You want to have emergency cash in the bank. Two banks that we've found that have a pretty decent rate are TIAA and the American Express Personal Savings Account. But my advice would be shop it like you shop anything else. If you have access to a company investment plan, like a 401k or a 403b, by all means, take that match to the max. It's free money. If you have the option to invest in a health savings account, do that. Those are pre-tax dollars that are also invested. And lastly, make sure that the money you're setting aside to invest, you're not going to need for 3 years. It takes about that long for the market to realign. And then have a positive mindset. Believe it or not, women outperform men by 1% per year. It's because we stick to a strategy, we trade less, and we're less likely to be market timers. And best of all, the average bear market or down market only lasts 13 months. And share. If there's a partner in your life or you expect there to be one, find out what you have and why you have it. Have your financial info in one place, including passwords. Keep track of how you're doing by checking once a week. And if nothing else, for cybersecurity reasons, because the sooner you react to it, the better. And know each other's passwords. Here's another personal story I want to relate to you. I have a very dear friend whose husband contracted coronavirus, and he was put on a ventilator. And she wanted to pay the bills, but she didn't know his passwords. That can be a very tricky and difficult situation. Now, why learn about investing? Because I want you to be like the lady on the left, not the one on the right. You want to be able to participate in your future. You want to have an intelligent conversation with your financial advisor and be able to objectively evaluate him or her. Bank interest rates are terrible. Really, the stock market is where you're being delivered results. And you want to help the young people in your life understand their finances. From what I understand, financial education for kids is not that great. Okay, so let's start. And what I want to do is give you an idea of how I started. First of all, learn from an independent source. The Wall Street Journal is really the gold standard of financial information, but it's not only financial articles. There are articles on families and tech, which if you've got kids studying at home today, you might find useful. They do book reviews, and they do something called Women In, which is about women business leaders. Now, if you need to find funds, of course, there's always your budget, but then maybe you're getting a bonus or you have a tax refund, or one of my favorites, let's say you subscribe to Showtime and you haven't watched it in a year. Well, there's some money that you might want to be able to start with. Now, take advice from trusted sources. We use financial newsletters because they provide independent research that may work for you. And rather than having you Google financial newsletters, I've put up there a website called hulbertratings.com. And what Mark Hulbert does is he evaluates financial newsletters. So it's a source for you to go to and say, I want to invest in dividend stocks. What kind of newsletters offer me that possibility? And you can use that letter then to start investing in stocks. Now, pretend you're investing. What I mean by that is when you're using this newsletter and you're picking stocks, put it in a fake portfolio. Pretend you're buying 3 or 4 or whatever stocks that are recommended and see how it does by following it for 3 to 6 months. And if it's up and it's working out well, might be something for you to try. And invest slowly. There will always be another stock to buy. Now, here's some do's and don'ts. You can actually start with as little as $190 a month. And my next slide is going to show you just how that does. Look for stocks that pay dividends. My credo is, if you want me to invest, pay me to invest. And then test before you plunge, like I mentioned, the fake portfolio. Now some don'ts. Don't invest only in your area of expertise. Just because you're a realtor doesn't mean you know all about real estate stocks. The market is about trends and a lot of other things. Don't put all your money in one stock or one sector. Diversification is so important. And don't expect to get rich overnight. Now, here's that example of that $190 a month for 40 years. Let's say you put it in the bank, and let's say that you're lucky enough to get 0.7%. At the end of the 40 years, that's going to be about $105,000 and change. But $91,000 of that is your original principal. So what did you make? A little over $14,000. Put it in the stock market, in dividend stocks. And I used a very low 7%, which is a low average for the market. And you could easily make $500,000. No guarantees, but you could. Now, actually, that figure might be a little bit low. You could actually be in the 7 figures because according to the average return of 10% for the S&P 500, you could be in that 7 figures. Okay, what are your options? Well, you can go with traditional advisors, and I'm sure you are familiar with these names. I picked ones that I'm pretty sure you can trade for free. My next slide. Okay, what do they offer? Well, you have a real person that will work with you for a fee or commission. You can set it and forget it. I don't recommend that. Usually there's a minimum investment of 5 figures, and they favor managed mutual funds. Or you can go the route of robo-advisors or online advisors. And I put Robinhood at the bottom because they started it all, but lately they've gotten into trouble with regulators. 2 of the top ones from a website called nerdwallet.com, which reviews these, are excellent. Ellevest is actually a site that was devised by women for women. Acorns is a little different in the sense that when you sign up with them, let's say you're buying something and it's $59. They will average you up to $60. They'll take that dollar and they'll invest it. And Bloom is all about helping you with your managed portfolio, your 401k, your 403b. What they offer? Well, they're all about algorithms. Usually there's a low or no minimum investment, and you have limited, if any, advisor contact. Now, here's a list of your investment options. And as you can see, there are a number of them. What I'm going to focus in on primarily are mutual funds, ETFs, and individual stocks. And I'm getting my slides a little mixed up here. There we go. Okay. And I need to move that. Okay. All right. There we go. Mutual funds. Okay. They're a basket of investment vehicles. They tend to have high fees. They're tax disadvantaged. And just a real quick explanation of what I mean by that is the mutual fund advisors are, oh, missed that. Okay, there we go. Let's say the mutual fund advisor has a group of stocks and one of them does extremely well. and he has to sell it because it has taken his percentages out of whack. Well, guess what? When he sells that stock, you pay the taxes. There's also a real lack of transparency of fees, and they only trade at the end of the day, which means that if you're wanting to make a change at 12 o'clock, you have to wait until the market ends. Then there's ETFs, or exchange traded funds, and they're also a basket of investment vehicles, but they trade like a stock all day, they're tax advantaged, and they tend to be cheaper than mutual funds. If you have a choice between a mutual fund and an ETF that offer the same thing, I would take the ETF. And I'm going to get in trouble with fund advisors about that. Okay, there are a couple of strategies that we use that we found to be successful. This one is based on a Nobel Prize winning strategy that uses a diversified portfolio of mutual funds or ETFs that are rebalanced once a year. Ergo, do that once a year and then do nothing or go fishing. The chart on the next slide shows you how it works. Now, if you'll take I hope you can see this pretty clearly. The first 4 columns represent an original investment. Now, let's say you're fortunate and a year later, it went up by $18,000. Now, in order for this to work, you want to bring the second set of percentages up to the first set of percentages. So you sell some of your winning shares and you buy more of the down shares. The whole idea being you sell high, buy low. The other way that we've been successful is to buy stocks that raise their dividends every year and reinvest the dividends. So what ends up happening is you buy a stock, you get a dividend, the dividend buys more stock, and so on and so on. Mark Lichtenfeld explains this very clearly in his book. And of course, I have to put in a pitch for my book that'll show you some examples in real life. Now, probably the best way I can explain investing in dividend stocks, which is really compounding, is to say, think of it as a snowball. It keeps rolling and getting bigger and bigger and bigger. And that's where compounding, to me, is the absolute best way to grow your wealth. So what will investing do for you? Hopefully, it'll lessen your financial stress. It will allow you to have a two-way conversation with your advisor, keep your brain active, and prepare you to handle your finances in retirement. Now, here are some resources I've provided for you. If you're looking for rates that banks offer, bankrate.com is wonderful. They'll show you the bank rates all over the country. We've been fortunate and have used the income letter by the Oxford Club for a lot of years, so I can recommend that for you. If you want to see how this impacts you personally, I love financial calculators. And there's a website called wealthyretirement.com that has a bunch of financial calculators for you. More resources, some books you might like to read. And I also have put up my website for you, sonjahaggert.com, and the name of my newsletter, which you can sign up on my website. Now, if you could help me with some research. I'm putting together a pilot course that I hope to offer. And my pilot will help professional women understand investment choices in plain English so they can move from savings accounts into higher earning alternatives without angst. Am I on the right track? I'd love your comments, love your feedback, anything you can provide. Please leave the email in the chat box. And thank you. I hope this has been helpful. Now let's see about taking some of your questions. Okay, 2 questions. What advice do I have if the 401k plummets? Leave it alone. Believe it or not, everything that goes down must come up and vice versa. And the worst time to sell is when things are down. Okay, will you be able to get copies of the presentation? Yes. Let me see, chat box. since I haven't been able to look at the chat box yet. There we go. Okay. All right.
There's one more.
One more? Okay. I'm not seeing the chat box.
Do you want me to read it to you?
Yes, would you please read it to me?
Sure. This is a question from Renee Dulles. I have set up a Roth IRA recently, but not invested the funds. What would you recommend?
Well, since I'm not a financial advisor, I can't do that per se or specifically, but I can tell you that if they offer you, for example, the stock market ETF or any type of general ETF, that would probably be a good place to start.
Okay, there's another question. Let's see. New question. Hello.
Okay. That's my helper speaking.
Okay, this is Daryl coming back at you saying, but I do not have time to recover from a plummet in the stock market apparently due to or related to the 401k.
So, oh, I see. You're not going to have time because you are going to be leaving your job probably. I would still say leave it alone.
Hey, Sonja, it's Linda. I'm watching the chat as well. And I'm wondering, I threw a question in about any particular details for people who may be over 40, 50, or 60 who have not been financially savvy up until now.
Well, I think you still have time. 40 is still young. You still have 20, 30 years ahead of you. And as I mentioned, if you look for example, an ETF that offers dividend stocks, or you look at some of the, what I would recommend are the dividend aristocrats. Now, these are a group of, right now, I think there's about 57 stocks in the group. And they're people that you know, Kimberly-Clark, 3M, companies like that. And they're committed to raising their dividends every year. In fact, the reason they're on that list is because they've raised their dividend for 25 years in a row. And you can't do better than that, especially if you reinvest those dividends for the next however many years. Anything else?
This is your opportunity. If anybody has any questions, throw them into the chat. We've got Sonja here, Sonja, our author. It's complicated stuff, I think, and I will share that I have always found this topic quite intimidating, despite being an economics major at Villanova as well as you, Sonja. I know we went to school at the same school, but I find this, yeah, and do you have any thoughts about advice we can give to our young kids? How long can we, at what age can we start telling our kids that saving money and investing, you know, will work for you? And any thoughts about that?
Well, my parents were always very open about their budgets and the costs of things. So that was a good way for me to understand money, which I think is where it should start. And maybe, you know, learn together.
I like that answer. Does anyone else want to throw a question into chat? All right, I think we are going to close out then.
Okay.
Sonja, thank you so much again. Unless I'm going to throw it back to you to do just a brief closing and any final reminders or comments, and then we will finish this one up for the day.
Okay.
So anything else you wanted to share with the group before we end?
Well, I'm hoping I'll get some feedback from you all.
Mm-hmm. All right. Well, with that, we will jump out, and thank you again so much for your preparing that presentation. I reminded the group that you will receive the recording in probably about a week to 10 days. And I see that some of you did share your email directly in the chat to get that Excel
Thank you.
spreadsheet. So, all right. Thanks again. And
Thank
we will
you.
see all of you attendees in a little bit. Bye all.
Bye-bye. Whew.
I'll stop recording now.